Good morning and welcome. Thank you for registering for today's finance update with BDO, which is always a highlight of the HOSPA event calendar. It's 8:30 a.m. It's Thursday, the 10th of June 2021, and we are all on tenterhooks in England, waiting to hear if and when the COVID lockdown restrictions are to be lifted later this month, and we'll find out on Monday. My name is Jane Pendlebury. I am the CEO of HOSPA, the Hospitality Professionals Association. We're here for 90 minutes today, and we are planning to dedicate the last third or so of that to Q&A. So please pop any questions for any of today's speakers into the address tab on the Go To platform. We will address more questions after the event should we run out of time. We are recording today's finance update, and we'll share a link afterwards so that you can spread that out to your colleagues as well. Thank you all for joining us. I'm going to hand straight over to Robert Barnard from BDO, who will talk us through the latest and most important finance topics, and then Robert will hand over to his colleagues. So over to you, Robert.
Thank you very much indeed, Jane, and good morning, everyone. I'm Robert Barnard, Head of Hospitality and Leisure Consulting at BDO, and thank you very much to Jane and the team at HOSPA for the invitation to speak at this webinar. It's my pleasure to be here. At BDO, we offer the largest multidisciplinary accountancy and advisory team in the UK, dedicated solely to hotels, leisure, and hospitality work. And I'm certain you'll also enjoy hearing from several of my esteemed colleagues today. Well, what a world we find ourselves in. And in particular, what a profoundly stricken yet innovative industry we find ourselves in. The hospitality sector is integral to the UK economy. It breathes vitality, joy, and connection into our society. It is in restaurants, pubs, and hotels that we forge new personal and business relationships, build on existing ones, and celebrate life's milestones together. Simply put, without hospitality, we are at a loss. However, as an industry reliant on social contact with high fixed costs, hospitality has been the worst affected of the pandemic. Despite government support measures over the last year, this has led to record lows in occupancy and RevPAR from the point of view of hotels, a distressing wave of job losses across the board, and even complete closures. It therefore brings me great hope that there is now a light on the horizon following 3 devastating lockdowns. I'm sure you have all enjoyed reuniting with loved ones in your local establishments as much as I have, hearing the familiar buzz of background chatter, the clinking of glasses and the clatter of knives and forks on a plate. For hotels, the story of last summer's success is very encouraging as trade restrictions relax once again, and the boom of the 2021 staycations will provide a much needed boost for the industry. Now we wait with bated breath for the full reopening of the sector on the 23rd of June, we hope. This, along with the sustained success of the vaccination rollout and the return of consumer confidence, will be crucial to recovery. But this has left me wondering, when hotels do fully recover, what will they look like? Will they resemble hotels as we once knew them? Or has the landscape around them changed so drastically that they will evolve to take on a new form and function entirely? It is anticipated, nay expected, that hotels will have used this time wisely to rethink business models and cut out inefficiencies. This means that once occupancy levels return to normal, or whatever the new normal looks like, their profit margins should, in theory, be stronger than ever before. But what does this mean on the ground? Hotels are having to think long and hard about what they can offer both consumers and staff to make their environment as safe and as reassuring as possible. Evidently, this means taking hygiene protocols more visible and implementing new technologies such as digital check-in and QR codes. However, the real challenge lies in working out how to manage communal spaces effectively if they now require social distancing, and probably will do for the foreseeable future. In particular, operational and customer areas intended for food and beverage present difficulties. To add to this, as we all know, F&B is a department that has been historically regarded as the least profitable part of a hotel. In the short term, hotels are offering grab-and-go breakfasts, full menu delivery in rooms, or allowing external companies to leave takeaways at reception. But in the long term, will it be sustainable to reopen a full-service restaurant with limited capacity? Instead, at its bare bones, will hotels become a set of self-contained accommodation units attached to delivery service departments? Perhaps. So will hotels look more like service department properties, the one sector of hospitality that has been able to prosper throughout the pandemic? Does this sound rather heartless? Again, perhaps. But if accomplished with style and charm, this new model could provide guests with the choice, personalization, and privacy they desire. At the same time, this frees up a whole host of commercial opportunities for repurposing, not only restaurant and bar spaces, but the kitchens themselves. Subletting what are known as ghost kitchens is an increasingly attractive prospect for hoteliers in the current climate. A study reveals that sales of deliveries and takeaways increased fourfold from March 2020 to March 2021. Delivery-only ghost kitchens, which might contain facilities for several brands or delivery services, would take full advantage of this online windfall and make better use of a hotel kitchen sitting idly. Similarly, host kitchens, where hotels partner with other brands to serve delivery-only food, are another potentially feasible option. And what about the restaurants and bars themselves, the lounges and lobbies? These represent many square meters of underutilized space, which could fulfill changing consumer needs, especially those of the corporate market. Remote working is here to stay, thus converting hotel public areas into co-working spaces is a resourceful and profitable solution, particularly if marketed cleverly to include add-ons. With many offices reducing their footprint, this provides a valuable solution for both hotels and local professionals seeking a quiet desk whilst engaging with the surrounding community. Hotels offer professionals flexibility, additional on-site facilities, and excellent service in central locations. In addition, virtual meetings and events have been a necessity during the pandemic, but their convenience and cost effectiveness has won over many businesses and individuals for good. The Global Business Travel Association stated that the number of hybrid meetings is set to double in 2021. As we saw with HOSPA's 2020, technology means it is now possible to host an immersive and engaging hybrid conference that reaches a mass audience, all for the safe confines of a hotel meeting room, reception room, bedroom, or even the new home desk. I, like you, don't know what the future of the hotel industry will look like, but what we do know, historically, it has bounced back from the slings and arrows thrown at it by political crises. Hopefully, I have provided some food for thought here today, and I look forward to seeing the reimagining of revenue generation unfold in our industry through the skills and expertise of our industry's creative and innovative experts. Thank you very much indeed, and I'd now like to hand over to Sarah Raymond.
Thank you, Robert, and good morning, everyone. I am going to spend the next 10 minutes talking to you about the restructuring landscape at the current moment. And as Robert said just now, whilst there is light at the end of the tunnel, we do expect there to need to be some restructurings, either operationally or financial, within the hospitality sector. If we just move to the next slide, I can give you some context as to the support that the government has been providing to business or businesses over the last 15 or so months. So as we know, we've had furlough, which will come to an end in is tapering. It'll come to an end in September 21. We've got the government-backed loans. We've had VAT deferral, and I'll talk about HMRC's position in a moment. But businesses have been helped by the VAT deferral, time to pay arrangements, and then we've obviously had the holiday from rates. Also on the legislative side, we've had no forfeiture of leases or CRA, collection of rents. That is due to end on the 20th of June. And so we've got two dates that we're looking forward to, the 21st of June and the 30th of June. I'll talk a little bit more about that in a moment. Also, during the pandemic, no winding up petitions have been able to be issued or statutory demands in support of them. Again, that is due to come off at the end of June. And also coming off at the end of June is a wrongful trading provision. So no actions can be brought by restructuring professionals against directors for losses incurred during the period in terms of wrongful trading provisions. If we move to the next slide. Thank you. So as I've just said, HM government support is due to come to an end on the 30th of June, and we don't yet know whether that will be the case or whether there will be that cliff edge at the end of June. There are hopes amongst many people that there will be an extension of these provisions to September, particularly for the hospitality sector, to give the breathing space of hopefully all the businesses being able to get back to fully operational trading. But as I've said, we don't know whether that is going to be the case. The government recently consulted, and many of you may well have taken part in this consultation, in the position with regard to commercial rent arrears and whether or not the forfeiture moratorium should come to an end at the end of June. You may well have seen the British Property Federation, the British Retail Consortium, together with British Land and Land Securities, came out in favour of a further 6-month moratorium for rent arrears, for commercial rent arrears, and that were incurred, I should clarify, incurred prior to the 30th of June. So that would then give businesses a breathing space to negotiate with their landlords a position in respect of COVID rent arrears, but they would be required to pay rent going forward from the 1st of July. So again, it's all up in the air. So there's still uncertainty for those businesses that have leasehold assets. So we know that this is being debated, and we expect a decision or some form of decision will come out in the next couple of weeks. Usually we find these that we hear within sort of a week prior to the cliff edge date. So not only are we looking at the 21st of June, we're also looking to the 30th of June in terms of the restructuring market. So we expect there will be a rise in restructurings if the government does release the provisions on the 30th of June. If we move to the next slide. One of the factors that will influence restructuring is the reintroduction of the Crown Preference, which happened on the 1st of December. It's only it will only be relevant to you if you've ever been through any form of restructuring. It means that the HMRC have preference in respect of VAT and PAYE. So if a business goes into a form of restructuring and enforcement process, such as an administration, the Crown will now have preference in respect of any VAT and PAYE that has built up. This is a complete change from many years where actually the government gave up its preferential status when it introduced new insolvency legislation back in the early 2000s. What it does mean is that lenders will now have a different position in the stack, in the waterfall of priority of how claims are paid out in relation to floating charge assets, so not fixed charge assets over property. So it does mean that if there is a restructuring, the lenders may well have a different attitude because they may well have a different recovery than they would have done pre-1st of December. It also makes HMRC a key player now in any restructuring, and particularly in relation to CVAs and restructuring plans, which I'll talk about in a moment. So we see also that there'll be a sort of tension for HMRC between the fiscal and political dynamics. So does HMRC want to support a business going forward and therefore agree to a restructuring plan, CVA, or does it want to collect in monies, debts, as quickly as possible? So there is a tension there, collecting debt or support business. And it will be interesting to see how that plays out. If we move to the next slide. So what does all this mean for restructuring? So we've clearly had 15 months of unprecedented support from the government. We have had insolvencies at an all-time low. So we know there will be businesses out there that would have otherwise failed. And so as we come out of the lockdown and businesses return to full trading capacity, we do expect that we will see more failures. But there will be also previously profitable cash generative businesses that will still be cash generative post lockdown, but have now got this balloon of debt on their balance sheets from HMRC, from HM government-backed loans, HMRC debt, and then also what we shouldn't forget, the landlord debt. So obviously the government will be seeking to minimise insolvencies as far as possible. We don't yet know whether they may well support the HM government-backed loans with further guarantees. That may well happen. If there is a spike in restructurings, we may see that the government takes a different attitude in relation to those guaranteed back loans. Not everything is in the control of the government, of course. So whilst they may be able to control the loans that they've guaranteed, and they may well be able to control the HMRC position, they can't control landlords. So there will need to be consensual or negotiations with landlords going forward. For businesses that are profitable and cash generative but have this balance sheet issue, there are several ways out. You obviously have a consensual deferral of debt, and which requires all parties to come together. So obviously the company has to negotiate with their lenders, with HMRC, the government, their landlords, and also their trade creditors. But if they can get a consensual deal, that is obviously the most preferable way of going forward. You have legal processes, and I will talk about two of those in a moment. And you have which allow a deferral and compromise of debts. And then you have the pre-pack sale, of which follows into an administration, which you will have all heard of. And finally, the most drastic route is closure, which Robert did mention earlier. We have seen the only rise in insolvencies over the 15-month period has been in relation to CVLs, creditors' voluntary liquidations, which is where effectively the business simply closes. So of the routes, we have two company rescue routes. One is a business rescue route, and the last one, as I said, is neither. And I just want to now just take a few moments to talk to you about the restructuring plan, which is a new plan that was introduced by the government during the summer. And you may well have heard that this has been used by Virgin Active. We're seeing it almost as an alternative to the company voluntary arrangement, which you will have heard about in terms of retail restructurings. Why the restructuring plan is of interest: this is a court-driven process, but it does allow a company to go out to various classes of creditors and put forward a plan. If one dissenting class of creditor, or if there are classes of creditors, I should say, that dissent, the court can still approve that plan and push forward the restructuring. And that's what happened in Virgin Active. Virgin Active proposed a plan. The landlords voted it down, but the court sanctioned the plan because they deemed it to be in the interests of all stakeholders, of all of the creditors. So that is a new tool in the restructuring plan, in the restructuring armory, which we think will come forward and be used a lot more. There's only been a handful. Pizza Express did it in the sector. So there's only been a handful, but we do expect to see more restructuring plans. We also expect to see more company voluntary arrangements. You may have read about New Look and Regis. If you're that way inclined, you may well have read about New Look and Regis. I did. These were company voluntary arrangements that went through during the course of last year. The landlords brought an action saying that the company voluntary arrangements were unfair, and this just came through the courts in the last month or so, and the court actually said, no, they're not unfair. The company voluntary arrangements stand. Landlords, if you didn't like it, you might not have liked having your rent compromised, but actually you always had the get out, which was to take your property back. So we see that, again, now we've had some clarity on the use of company voluntary arrangements, we see that there will be another sort of flow of those during the course of this restructuring period, which we think will happen in Q4 of this year. So it's an interesting landscape in the restructuring world, because we now have a new option of the restructuring plan. We now know that the CVA does work. The landlords might not like it, but it does work, and we always have the backstop if we need to of a pre-pack administration sale. So it'll be interesting to see where we get to in terms of volumes of restructurings. We do think we believe that these will pick up in Q4 of this year. So obviously, it doesn't mean the closure of a business. It might just mean that the business is restructured in a way that it can survive, and hopefully that will mean that there will be lots more hospitality businesses that can survive into the future. I think that brings me just about to the end. I'm going to pass over to James, who's going to give us a roundup of current tax issues. James, over to you.
Thank you very much, Sarah. Good morning, everybody. Can I move on to the next slide, please? The areas that I'm going to be covering this morning are just looking at the corporation tax rates and the new loss relief rules, then moving on to cap allowances and the super deduction that you no doubt have heard of, and then finally talking about off-payroll labour, which has been in the news quite a bit recently. Next slide, please. So kicking off with corporation tax, this government has kind of prided itself, certainly for the last 10 years or so, on having one of the lowest corporation tax rates across the board. But it's clear that COVID has to be paid for, and it's also clear that the Chancellor has decided corporation tax is going to be the one that bears the brunt. So we've got a 6% rise on corporation tax to 25%, and that kicks in on the 1st of April 2023. The Chancellor kind of takes on one hand, but he does give on others. So we have a new, more generous loss relief rules. Currently, well, you can always carry corporate tax losses back 1 year, but there's a temporary extension to extend this 1 year to 3 years. And this applies for accounting periods that end between the 1st of April 2020 and 2022. It's done on a LIFO basis, so you use the losses against more recent years first. There's no restriction on the 1 year carryback, but there is a cap on the losses carried back to years 2 and 3 of £2 million. And I've got some examples on those. For the extended loss, in other words, to years 2 or 3, the carryback claims are required to be made in a return. What do I mean by that? Well, I mean you have to have finished your statutory accounts, you have to have done your corporation tax comps and return, and you to have done everything as normal. So you have to wait until the end of the process. However, there is a de minimis of 200,000, which gives a much streamlined procedure, and you don't have to wait for statutory accounts. You can make the claim outside of a return based on management or draft accounts. I just want to pause here for a second, because there's a couple of observations I have. I know that, yeah, the vast majority of businesses, cash is absolutely king, and loss relief claims are the way to go. But if you do have alternative forms of finance, just going back to the corporation tax rates increasing to 25%, yeah, a better route might be to carry the losses forward to 2023, if you can. The other point to note is that the HMRC are taking quite a long time to process these carryback claims, certainly the informal ones. A number of months is not untypical, and it does take a lot of chasing, gnashing of teeth, and dare I say, biting of the tongue. So can we go on to the next slide, please? This is just an example that shows we have a situation where the company has made a loss of 4.3 million in 2020. It can carry back 1 year, that's fine, so it carries back 2.1 million without any restriction. But it's then capped out at the 2 million for 2018 and 2017, which is why we have that restriction. Next slide, please. Applying this to groups, the group are also subject to the cap of 2 million, but there's a bit of a quirky rule here that might be of interest in some situations. If we take my example, companies A, B, C, D, E, A to D all have losses less than the de minimis of 200,000. So you've got a total of 700,000 of losses there. That means E, which has got a larger loss, is capped out at 1.3 million because you're subject to the cap overall of 2 million. If you didn't have company E in your group, instead you had E, F, G through to Z, all with 200,000, the 2 million cap doesn't apply. This is intended, it was made clear in the guidance. It's just a bit of a quirk really, but it could be very useful in the right circumstances. Next slide, please. So moving on now to capital allowances, and specifically the super deduction, which did catch the headlines, and it is generous. It applies to companies within the charge to corporation tax. The headline is really all regarding main pool rather than special pool. So, if you have a hotel that spent 10 million on furniture, for instance, currently you'd get relief at 18%, or historically, should I say, you'd get relief at 18%. But now you get relief at 130%. So if you spend 10 million, you'd get a tax write-off of 13 million. Alongside that, you've got an increase in the special rate, which historically was at 6% writing down allowance, now is up to 50%. This is more of an acceleration, really, rather than a super deduction. What we're talking about here is integral features, so it's background plant and machinery and properties, things like air conditioning. It applies to capital expenditure incurred between 1st of April 21 and 23. Contracts have to have been signed after budget day, 3rd of March. The plant and machinery must be unused and not second-hand. This point, again, can be relevant in some circumstances. When the rules first came out, property lessors and landlords were not allowed to take advantage of the super deduction. And this was potentially going to give us quite a bit of a headache, because quite a lot of hotel groups have got PropCo, OpCo type structures. And but anyway, as the bill went through Parliament, the government did a U-turn on this, and so now the deduction is available to property lessors and landlords, and the finance bill has now been substantially enacted, so there can't be any more changes to it. It is worth noting that the annual investment allowance, 1 million, currently 1 million to end of the year, is also available to all businesses. And on the super deduction, there are, as you'd expect, anti-avoidance rules and also special provisions regarding the disposal of these assets. You have to track the assets that you've made a super deduction on, and you do have a balancing charge when you come to sell in the future. Next slide, please. The last area I want to talk through is non-payroll labour, which has received quite a bit of publicity for a variety of reasons, really. The first, across the UK generally, there's an increase in the use of contingent workers. I'm also very aware that in the hospitality industry, there's a shortage of workers in some parts. It's important that engagers, in other words, the hotels that take on these workers, that there are pay-as-you-earn and national insurance risks in certain situations. And these all stem from the new IR35 rules, which were implemented in April of this year. Just taking it at its most basic, if a hotel takes on a worker but does it through the worker's personal service company and engages with that personal service company, before April of this year, the pay-as-you-earn and national insurance risk was pretty much with the worker and his personal service company. But that all changed in April, and now the pay-as-you-earn risk is with the hotel. So it doesn't just apply to personal service companies. As you can see on the slide, there are other at-risk workers, so agency workers, directors, you can see the list. So what do you need to do? Well, you need to assess the employment status of anybody of at-risk workers and decide, would they be self-employed or an employee? And if the latter, you need to deduct pay-as-you-earn and national insurance and liaise with them. There are penalties in this area alongside a soft landing for the first year, but that doesn't include the actual pay-as-you-earn national insurance, only the penalties. You may be aware that there's been a lot of adverse publicity about what they call mini umbrella arrangements. Mini umbrella arrangements, basically it's just a corporate wrapper used by an agency, and HMRC have said these have been used not only for avoidance to get the employment allowance, reduced rate, reduced level of pay-as-you-earn national insurance, but also for fraudulent purposes. So it is very important that if you take on any workers through this type of arrangement, you do diligence on them and find out where and how the pay-as-you-earn is being levied. Right, on that point, I will now finish and hand over to Martin Pearson, who is going to talk about VAT hot topics.
Thank you, James. Next slide, please. So during this session, we'll be taking a look back to 2020, focusing on some of the key indirect tax changes that came into force. We'll also be looking at 2021 and what the rest of the year has in store for the hospitality sector. Like Robert said, 2020 was a year like no other for the hospitality sector and was badly impacted by COVID and lockdown. HMRC were quite sensitive to this and introduced fairly quickly some new measures for indirect tax. Firstly, like Sarah mentioned on her slide, we saw the introduction of the COVID-19 deferral for VAT payments. Actually, great news for businesses is it enabled them to use cash flow, the cash that they would have paid to HMRC for wider business purposes, and there was a huge take up at the time. If we look back, some businesses have repaid that in full, whilst others have opted for the wider repayment option. We continue to be asked lots of questions on the deferral extension arrangements, and some of the questions probably weren't envisaged to start with. So questions such as, what happens to my COVID deferral extension if I deregister for VAT? What is the impact of leaving or joining a new VAT group? And questions such as, what happens to the VAT debt to HMRC if I transfer my trade and assets as a VAT-free going concern? In the majority of cases, the VAT debt to HMRC will remain with the corporate legal entity. However, if you are considering a change to your current VAT status, this is definitely an area that shouldn't be overlooked. The second area that I'm going to talk about is the Eat Out to Help Out arrangement. And it was another welcome incentive to the sector. And whilst obviously this has come and gone, it still seems to be a hot topic for audits and due diligences. It would seem as if the main point of contention really is the question of what value should VAT have been accounted for at the time the Eat Out to Help Out scheme was in place. So should it have been the consideration received from the consumer only for the food and beverage, or should it be the combined amount received, including the government payment? Now, HMRC in their guidance wasn't overly clear to start with, but they have confirmed that they do expect businesses to have accounted for VAT on the full consideration received. So that's the amount actually paid by the consumer and also the government payment. So it's slightly confusing for some businesses because in some cases, some hospitality businesses thought that the government payment was akin to a grant. And typically in a lot of circumstances, grants are outside the scope of VAT. So we have, as I say, we have seen this being picked up on audits, and it has been a key question for hospitality due diligences. So I suppose my key point here is that if you've operated the Eat Out to Help Out arrangement, then this is a definitely an area that you might want to have a look at this year, just to make sure that you are clean and have accounted for that correctly at the correct rate. Yes, last year was very busy. So we also saw the introduction of the temporary reduced rate, incredibly hospitality focused. And it's nice to see that the application has been extended further this year. The issue with this guidance is that the devil is actually in the detail, and the rules are complex in practice. We've been working with lots of businesses over the past year to look at the VAT rates applicable to items such as room service, service charges, delivered takeaway and mixed bundle packages. As whilst the guidance was relatively straightforward, and I think initially there were only a few sentences that were issued by HMRC, in reality the position is fairly complex, and I don't think it was envisaged that for the hospitality sector the added complication of things such as deposits and adding vouchers in the mix have made businesses kind of step back and have a think about what rate really should apply to the supplies that I make. As I say, the guidance is a little bit subjective. So again, if in doubt, it's best to try and obtain a written ruling from HMRC. They've been quite good, and we have received a whole raft of questions being answered by HMRC around some of these points. So as I say, definitely worth a little bit more consideration than you may have thought to start with. Oh, sorry, next slide, please. Finally, I've come to the final bit of this slide. The last thing we've really seen again is HMRC's revised view on deposits and cancellations, and the fact that this still is causing some confusion for the sector. So HMRC's revised guidance talks about the fact that such prepayments are payments for future supplies of the underlying supplies to be made, and therefore should be subject to VAT at the applicable rate. Now that links in quite nicely to the temporary reduced rate position and what happens around kind of the rate date changes and how should you treat the VAT on those deposits and vouchers. I think the whole issue of compensation still needs to be considered because the real question comes down to what is true compensation? Can you still have a cancellation charge that can be treated as outside the scope of VAT within HMRC's wider guidelines? And I think in order to determine the position, you really need to look at the commercial terms and look at what you're doing in practice around for cancellations, things like refunding. Do you refund all the money? Do you retain some of it? And how does that work through with regard to HMRC's guidance? So I think even though 2020 was a very busy year, lots of things introduced on the indirect tax side, I still think there's lots to consider when we look back and see how they should be applied, not only last year, but going forward. Next slide, please. So as we move through 2021, we have seen more changes. Brexit is still high in the agenda for many businesses. Now, whilst not so much of an issue on the sales side for UK hospitality, as we typically have UK domestic sales, we have been seeing a little bit of pressure around the purchase side and really understanding your supply chain from an import perspective. So we've seen an increase in some cases on costs coming in. Questions around supply chain. Should I be the importer? Should my supplier be the importer? And what does that actually mean from a VAT and wider customs perspective? So I think the key thing to remember here is that customs duty is an absolute cost, but the import VAT can typically be reclaimed. So again, a word to the sector around making sure that you understand your supply chain, not just on the sales side, but also understanding kind of your purchase position. So with Brexit, we've also seen some impact with regard to the tour operators margin scheme. Now that's obviously not core hospitality, it's one step slightly removed, but we have seen a move around a decrease in the TOMS regime only being applicable to UK transactions. And I expect as we move forward through 2021, we will see some more changes for those falling in the tour operators margin scheme, not necessarily in the UK, but actually we've seen changes or suggested changes in Germany and Croatia around the taxation of non-EU tour operators buying and selling hotel rooms in those countries and having local tax liabilities. This year, we've also seen the introduction of phase 2, making tax digital, and that basically looks at the requirement to digitally link records from the 9 boxes back to the export of the data out of the accounting system. We've had lots of conversations with hospitality businesses about some of these issues. There seems to be quite a fundamental issue around data being transferred for booking systems back to core accounting systems and manual entry still being used. One particular area of concern is around recognition of revenue for deposits and the fact that some of the booking systems don't recognise a deposit being a taxable supply at the time the deposit is taken. Some businesses have spoken to HMRC and are looking to agree workarounds with regard to those type of manual adjustments that can't necessarily be backloaded into the accounting system. So I suppose with regard to making tax digital, if you've not looked at it, it's definitely time to look at it. It came into play for VAT returns commencing on or after the 1st of April. The key thing really there is to do that walkthrough from the 9 boxes upload back to the accounting system and see what manual entries you're making and work out whether any of those can be pre-populated or pre-programmed into the core accounting system. A common area we see is the reverse charge, where a lot of the time it's done on a manual entry basis, but actually there's capability within the accounting systems to capture that data when the invoices come in. So definitely something to watch out for. Now, finally, we have seen the final introduction of the domestic reverse charge for construction services. Now, that will impact the hospitality sector, many of you probably being end users. The whole idea of the domestic reverse charge was to help to prevent VAT fraud in the supply chain. And actually, it's quite good for cash flow, because instead of paying the VAT and reclaiming it back, if you are throughout the chain, apart from being an end user, you can adjust on the VAT return. So I suppose a key thing for you guys in the hospitality sector is knowing whether you are the end user and notifying correctly. There has been some talk and some suggestion as to whether you can opt in and out of end user status, and what does that actually mean. If there is an option to opt out of end user status, then cash flow wise, you're able to pop the VAT on your VAT return instead of paying it to your supplier and reclaiming it back. But I suppose my word of caution is that, again, the guidance from HMRC is not overly clear on this point. And if you are looking to opt out of end user status, although HMRC have said there's no formal opt out, that you do go to HMRC and you protect yourself by getting something in writing to that effect. So very quick whistle-stop tour of VAT. I suppose the key thing to remember that VAT is an absolute cost to your business. So it's really important to ensure that where possible, you maximise your VAT recovery and minimise your VAT payable where possible. Unfortunately, the rules are not straightforward, and there's always quite a lot to think about. So I will now pass you over to Katie, who will talk to you about R&D.
Thanks, Martine. And quite a salutary warning on the VAT side of things. I don't suppose we always think about it in terms of cash, but you're totally right. There's a cash cost to the business. And really that leads nicely on to the world of research and development tax incentives, because I guess the key question, you're probably sitting at me and looking at me wondering why we're doing this part of tax topic. And that's really two key things. And the first of those leading on from Martine's is cash. We know that hoteliers and those in the hospitality sector are very cash focused at the moment. And if you can qualify for these research and development tax incentives, they do have immediate cash boost, both to your bottom line, but also to your cash as well. And the second reason for inclusion is that we're seeing a lot of innovation in this sector. So that might be COVID inspired innovation. So things that you've had to do to change your processes to make them COVID secure and safe, or also an acceleration of trends that we'd already seen in the world of technology. So things like contactless check-ins that have been around, but I think are more likely to be taken up over this period of time. Okay, so if I just go on to my next slide, we're going to talk, this is just going to share with you what I'm going to cover in my 10-minute slot. So the first is, what is the meaning of research and development for tax reasons, and how does it apply to the hospitality sector? Because I know it can often sound like something that should just be done in a lab, but in reality, it really isn't. The bar isn't set at that level. And so getting an understanding of how it applies to the sector. Secondly, what it's worth, that's the key focus, right? In cash terms, how can it help you? How and when can you claim? And also the impact of COVID-19 that we're seeing on R&D tax relief claims now. And finally, an important update for those people who are already claiming R&D. So bear with me if you're already on the R&D bandwagon, there's something in this for you as well. So next slide, please. So at its simplest, the definition of R&D for tax purposes has three key things. You need to be making a scientific or technological advancement, or seeking one at least. You need to be seeking to resolve scientific or technological uncertainty and following a systematic approach to do so. Now that sounds quite lofty, but actually when you look at what that means in terms of the definition, it simply means something that is an appreciable improvement over what's gone before. So if you look at your existing technology systems, and you have made them into something better, that's typically where we would see qualifying R&D activities. So as I say, please don't focus too much on the need for those advancements of uncertainties. Really what we're looking for are things that are better, products, processes, IT systems that are better than have gone before. So if we flip to the next slide. And here, what I wanted to share with you are some examples that I think are more relevant to the hospitality sector. So this is everything from a claim we made where we were looking at the underlying technology and seeking to increase the conversion rate from browsings to bookings. So a key area for hospitality, someone lands on your website, how can you help achieve the booking from that browsing piece? So we've looked at the technology for that. We've looked at the technology behind the hotel linen process, so cleaning hotel linen and all of the machinery and IT systems that are all used in that to trace linen through the process and also through the cleaning process itself. And back-end systems too. So a lot of R&D claims that we'll look at will involve your existing IT systems. That could be your ERP system or your online booking system. Lots of older companies have very historic internal IT systems, which means that when you add components onto them, they create technological uncertainty. And the definition of that for reference is system uncertainty. We've got two known components, but putting them together can cause uncertainty. So all of these areas can include technological uncertainty. But as well as that, in some areas, you may well have scientific uncertainty. And that can be around things like new product development, around healthier foods, if you have your own restaurants or provide food in some way yourselves. It could be cocktail recipes. We've seen claims for people putting together new and innovative recipes, even from that sort of sense. So there can be technological, but also scientific uncertainty. And another area here relevant for hospitality is where you've got any form of diversification. So let's say you've created some own product ranges and how that development has happened and how involved that you've been. What I would say at this point is that there are a couple of really key considerations for the hospitality sector, and this is common with a number of different sectors. And this is around whether you do the development work yourselves in-house, so whether you choose to take on some people within your team who know about IT, who can give you a cutting edge differentiator in the market, or if you choose to outsource all of that. So you say, I'm great at my own sector and my own piece, but I'm going to outsource the IT to somebody else or the scientific work to somebody else from a food or technology point of view. So from our perspective in analysing that for R&D, it's important, are you doing it in-house? Are you outsourcing as a joint venture, or are you doing the projects yourselves? However, regardless of which of those functions that you are doing, the question is whether or not you get this cash from R&D tax relief, or the supplier that you're using is getting this cash. And understanding that can mean that you can factor this into your commercial negotiations as well. So if I flick on to the next slide, this is where I'll talk about the cash. So there's two schemes of R&D tax relief, one for small or medium enterprises and one for larger businesses. And broadly here, a large business is one with more than 500 employees. So typically hospitality tends to fall into that larger regime. For those larger companies, the cash rate is 10.5% of spend. So if you spend £100, you can get £10.50 literally back in cash from HMRC to support that spend on research and development. If you're a small or medium enterprise, that cashback rate can go up to 1/3, so quite significant. So if you do the work, so you own the project and either do the work in-house or you've got people working for you, agency workers, etc., to do it, you're going to get that 10% cash benefit. But even if you outsource it, even if you say, actually, I just want to subcontract this to someone who's good at it, bear in mind that they will have the cost of that work funded by up to 10% as well. So as you go through that commercial negotiation, just have a think about where R&D tax relief fits. Okay, so if I flick on to the next slide. So I just wanted to talk a little from the beginning through of what the process is. How do you go about making an R&D tax relief claim? Well, step one is about identifying all those projects that you're involved with that have some sort of scientific or technological uncertainty. And there may be obvious people in the business to speak to about that. So if you have someone in charge of the technology in your business, there would be an obvious starting point, or even a discussion with the board about whereabouts in the business this might apply. And I think having those discussions at a very broad level helps both in understanding what investment you have across the business in science and technology, but also where this 10% cash could come in. And once you've got that basis of, we've got a number of different areas of the business where we're investing in technology, or we have invested, we can start to have the discussion about, does that involve R&D tax? And if it does, whose claim is it? Where's this cash going? So the second part is exactly that, working out what it's worth in cash to you. So taking the projects that we've talked about before and then working out, is that cash that's already due to you? And it will be due to you if you've already spent the money. Or is that cash that you will get in the future as you invest in that R&D? And again, knowing that you'll be funded 10.5% is quite a considerable encouragement to invest in technology for the business. So in terms of actually making a claim, what happens is that you submit the R&D numbers with your corporation tax return. So you need to have passed your year end, you get your signed accounts and your corporation tax return, and your R&D tax relief claim goes alongside that, so within the CT return. And we usually submit an accompanying R&D report. And all that does is set out to the UK tax authorities, what are we doing and why does it meet that definition of R&D? So that provides a first line of defence against any questions that they may have. And this also gives opportunity, because you have 2 years from the end of an accounting period to make an R&D tax relief claim. So if you're a 31 December year end, we could look now at the expenditure for the 31 December 2019 and 2020 open tax years and see if we could reclaim cash in respect of those. And then what happens? So you submit this tax return with your R&D figures and your accompanying report, and HMRC currently typically pays within about 4 weeks, or maybe even 4 to 6 weeks in terms of larger businesses. So if I flip on to the next slide, I just wanted to talk a little bit about how has COVID-19 impacted on R&D tax relief claims? And there's a few ways. Firstly, and importantly, as I mentioned at the beginning, changes to business models may mean you've actually spent more in R&D this year than you either intended, or you've had to change because you've reacting to how COVID has changed society as much as anything else. And having seen some of those business model changes, I think R&D tax could easily be missed off that agenda, and it's an opportunity to claim back some cash to recoup some of those costs you've also had to spend. Many of my R&D clients are really focused on getting their cash back and getting it back as quickly as possible. So I'm working with them on how can we improve the timing of a claim, so getting those accounts filed quickly and the tax computations prepared quickly so that the R&D claims can be made as promptly as possible. Thirdly, an impact has been that if people are on furlough, it has been harder to get hold of them and actually put those R&D tax relief claims together. So just that ability to assess R&D, I know people have come back off furlough, but getting access to them can be tricky. And finally, the interaction between the government supports and this R&D tax relief, because both are clearly high levels of funding available from the government, and that small or medium enterprise R&D relief I talked about, which funds up to 1/3, can't be combined with things like the furlough scheme. So if your people have been on furlough, effectively they can't have been doing R&D because they haven't been in the business, and therefore they're ineligible for R&D for that period of time. So just being aware of how they fit together is quite important. And finally, I said I would touch on some updates for existing R&D claimants. So if we flick to the next slide. There is a current HM Treasury consultation, the first round of which is closed. We expect there to be more questions on this. And I'd really encourage this sector to engage. And one of the reasons for that is that one of the things under consultation is the definition of R&D itself. And there is a lot of innovation across the hospitality sector. And I think when I flash that first definition of what is R&D up, it seems like it doesn't tie in. So I think if there's ways that you can explain where you do innovation, but it doesn't necessarily fit that definition, but it should be funded by governmental support, and also in helping to explain how it applies to your sector, as I did as part of this presentation. But any further examples that you have from claims you've made, I think are going to be really important. There's a real opportunity here to make this relief more prominent and more accessible. So you can see, if you follow this link, our thoughts on the future of funding via R&D tax relief, and I'd welcome your thoughts and considerations on it too. So I'm going to hand over now, I believe, to Mark. Hello, Mark. Take you on the next sector. Thank you.
Thanks, Katie. Good morning, everybody, and thank you very much for tuning in. It's great to be talking to you. There's so much going on, as you've heard over the last hour. We're really keen to have opportunity for Q&A, so please do raise questions in the chat function, which Jane has highlighted on the webinar. We're very keen to take those. I'll just very briefly cover a couple of hot topics on the financial reporting side, but you'll be delighted to know that after all the change in every other area that we've gone through already this morning, there actually isn't that much significant going on in terms of accounting standards and needing to worry about things. So three headlines, if you like. Firstly, leases. If you have leases in place, whether you are a UK GAAP reporter or an IFRS reporter, if there is a COVID-related concession, then there is going to be an accounting impact for you to consider. One of the key things here is that the GAAP treatment between UK GAAP and IFRS is different and quite divergent. So that's unusual, but it does mean if you're group reporting or if you're considering different GAAP measures, then you do need to watch out for that. So that's number one. But that's in a way, the most significant financial reporting change that we've seen over the last 18 months. A couple of other things in terms of what has been the then, the now, and the future. You will have been used, no doubt, now to the Section 172 report, that part of the strategic report which you're required to include on your website, which talks about stakeholder engagement. This is for large companies. One of the things that we've seen increasingly is that the Financial Reporting Council, who monitor these, have fed back on what makes a good Section 172 statement. And a lot of companies previously considered running through different stakeholder groups and then decisions that were made for those stakeholder groups. Given the year that we have had, the 18 months that we've had, it is likely that those reports may feel better and more coherent if actually the analysis is switched slightly so that it's considering key decisions being made, including opening, reopening, staff changes, use of furlough, other funding, etc., and then how the stakeholders have been communicated and interacted with. This isn't simply a list of decisions made, it's critically about the interaction with stakeholders, including employees, so consultations, etc. So Section 172, it has been around for a while, but there's increased focus in terms of what it says. The other key point which is coming out, most people sitting within a large corporate will be now thinking about carbon reporting. Clearly those numbers will have been slightly odd over the last 2 years, so it's quite hard to make sense of what's going on with those, given that hotels have been shut for such a significant period, restaurants have been shut. So that makes the numbers slightly challenging, but it does mean you can't really leave it to the last minute to think about just putting in numbers, because if you're talking about a strategy, etc., clearly what we actually hope is that by next year when you're open, those numbers, those emission numbers will actually go up, but it'd be worthwhile highlighting that to people so that they're not surprised by that. But if you have a strategy, nearly everyone will have a strategy, maybe some of it linked to research and development, maybe some of it linked to investments where you'll get super deductions, etc., then it's worth highlighting those and being clear around what impact you anticipate that should have on your figures going forward. A couple of points from an audit perspective, again, the then, the now, and the future. What are we seeing? If you are holding your property at valuation, then valuers are continuing to have material uncertainties around valuation. That then leads to an impact on the audit report. So that we think will continue for a period of time. Likewise, going concern, people often ask me, well, what's the impact on the audit report nowadays? Are we getting light at the end of the tunnel? Does 21st of June make any difference? The reality in terms of what we're seeing is that actually, while a lot of excuse me, banks have been very supportive over the last period of time, we are beginning to see now waivers being much more short term, agreed a bit later, more challenge of credit, and the desire, once trading does begin to reopen and there's a bit more certainty about trading patterns, to put those covenants in place. Given that we don't know exactly what the future of travel is going to be, to allow hotels to trade on their return to pre-COVID levels, that is likely to lead to some degree of uncertainty. So whether it's a material level or not will depend case by case, but I think there's an acceptance that actually, in terms of forecasts, there is a significant degree of uncertainty within those. So I do anticipate the sector will still see some highlighted paragraphs in audit reports and in accounts around going concern and material uncertainties there. Next point, just to highlight, if you're seeing that your auditors are changing their audit report and now they've got a big section on fraud, that is normal. That is in fact a requirement. Auditors now need to explain in their audit report what work they've done to consider fraud. And because of some of the items that have been mentioned, including use of furlough and other grants, and the statements that HMRC have made about fraud risks, they are being highlighted in a number of reports, not in any way suggesting that there are problems per se, but just highlighting the work that is done and the comfort that's gained by those procedures. So do look out for that and make sure you're kind of clear on what the auditor is saying and the work that's being performed. Final point from me, which is one very much for the future. You may be aware there is a current consultation that is out with BEIS around, well, not just audit reform, but actually reformed governance structures in the UK, including looking at the definition of PIEs. So that is public interest entities, traditionally restricted to fully listed entities or very significant entities. There was a separate definition for OPs, other entities of public interest, which was large privates over 2,000 employees, but within a single corporate entity. That consultation could expand that definition of PIE, which could bring a number of groups into PIE scope. So even if you think you're private, you might suddenly be in full regulatory scope, both from an audit point of view, but from a governance point of view. Very significant potential changes. So that consultation is open until July. It's something that will be on the horizon for the next couple of years. It does include the possibility that the equivalent of Sarbanes-Oxley in the US, there'll be a UK SOX equivalent. So watch that space. It's going to be potentially the biggest change in terms of corporate governance, reporting and control environment testing that we will have seen in many a year. So very significant changes potentially coming up. They are the key things from me. So I will hand back to Jane now, I think, who is going to see if there are questions coming in, and we will happily do our best to answer them. Thank you very much.
Thank you very much, Mark, and thank you to Robert, Sarah, James, Martine, Katie as well. They were all really useful insights there, and we do have a fair few questions coming in now, but do keep them coming. We've got just a little over 20 minutes to address them. So some are very similar, so I might merge a few together. So if your question doesn't appear to be answered in the way you asked it, then I apologise for that. I'm just getting some together. First one on the non-payroll worker. If you're a small company, does the responsibility lie with the worker? So I think this is about the small company or the PSC instead of the hotel employer. And I think there is a limit there, isn't there? That was, I think, something that James covered, but maybe somebody else would answer that one.
Jane, I can happily answer that. So if you fall within the corporate tax definition of small, then the current IR35 rules that were applied up to the 5th of April 21
will continue, which effectively means that the individual in their own personal service company is responsible for assessing at the end of the year whether the engagement that they've had is one of employment or self-employment, and if so, they would operate IR35, i.e. pay as you earn and national insurance on that. The one thing to add though is if we are talking hotels that do fall into the small category, there are some additional responsibilities for them, which include answering any inquiry from a personal service company to the size of their business so that they understand where they fit within the IR35 rules. Hopefully that's
Great.
okay.
I think that answers it perfectly. Thank you, Jackie. There's a couple of different ones here about, I think these are hotelier questions about pro forma invoices. Both from a refurbishment point of view, the question is for a hotel refurbishment, we are having to pay pro forma deposits to a lot of suppliers for goods being manufactured. They are refusing to issue VAT invoices until the goods are delivered, which is up to 18 months later, although VAT has been included on the pro formas. So that's clearly a cash flow. And then there's another one, a very similar one, about somebody who's booked a venue for a Christmas event and paid a pro forma deposit. And the venue said they will raise the VAT invoice after the event. So I guess that's one for you, Martine, isn't it? Just to clarify that sort of pro forma VAT issue on those two aspects.
Yeah, no, sure. So yeah, a pro forma invoice is not a tax invoice for VAT reporting purposes. So a pro forma is effectively a request akin to a request for payment. So no VAT would be accounted for by the supplier at the time the pro forma is raised. And you're right, you have no right to deduct the VAT on your input tax side because you don't have the valid evidence to support that position. So that's kind of the technical position to be in. From a commercial perspective, you either have to force them to give you a tax invoice, which will create a tax point, which will give you the document to allow you to get the VAT recovery, or you might want to go back to them and say, whilst I'm willing to pay the net value, I'm not willing to pay the VAT amount until you give me a VAT invoice. So I think there's not much you can do with pro formas, unfortunately. It's what suppliers do in order to obtain those deposits. The interesting thing is that on receipt of, when they receive money from you, that itself creates a tax point for their own VAT reporting. So whilst they issue a pro forma and don't give you the evidence for the VAT recovery, they will have received the cash prior to the issuing of a tax invoice or the supply being made. So actually, for their own VAT reporting, unless that money is put in a stakeholder or an escrow account, they should be paying that VAT to HMRC. So that you might just want to push them on the issuing of a tax invoice in any event. The second one is probably quite similar, isn't it, Jane, in respect to the Christmas party thing. So I think you probably want to have a conversation with them around that as well.
Yeah, absolutely. I think from what I know, the property management systems within the hotels and venues quite often just can't cope with it from a system perspective. So yeah, interesting. Pro formas are clearly one of those things that are open to debate on both sides. A question here about job retention grants. Do they have to be reported as revenue as opposed to crediting against payroll costs? I don't know who would like to pick that one up.
I shall give that one a go. Okay, so job retention scheme is a government grant, so it falls into government grant accounting. The rules are pretty clear in terms of if you are a UK Companies Act accounts preparer, so that is you prepare your accounts under FRS 101 or FRS 102, then the job retention scheme must be shown as an other income or form of revenue. And the payroll cost is gross. If you are an IFRS reporter, so under international accounting standards, either as endorsed by the EU or now the UK IFRS standards, then you can net those against payroll costs. However, because if you are preparing UK accounts, albeit under IFRS, you will be required to disclose how much of a grant that you have received. So you can net it off on the P&L, but you will need to give the full detail of your payroll cost in your payroll note, disclosure note.
Yes, thank you. And whilst you've got the floor, Mark, I've got another one for you. First of all, a compliment on your concise and pacey delivery as usual. So thanks. You will. This is particular. I think it must be one of your clients. You will almost certainly have previously alerted me to this. But did you say that is it the S72 must for large companies be published on their website?
Yes, that's correct. So section 172 is a publishable document. So you can either include in your financial statements a completely separate section, which is then published on your website, or you can just publish it separately, or you can put the entire set of financial statements on your website. Yeah, that is a requirement. I can't honestly hand on heart say that everyone is complying with that. However, that is an obligation that directors have.
Okay, thank you, thank you. I'm just reading this one fresh. It mentions VAT. So Martin, it could be you. Let me read it properly. Any comments on how, in practice, these issues and systems affecting VAT, capital allowances, etc., are handled where hotels are operated under management contracts, possibly multiple brands and often remote ownership? How do BDO cope with these?
Are we talking about from a reporting, making tax digital perspective, maybe?
It doesn't clarify that. So yes, I think it's. It could be.
Could be. I take it that that's the position. So we do quite a lot of VAT returns for hoteliers, non-established landlords, where we have property managing agents provide PDF documents rather than the source data. So for making tax digital purposes, we've had to go back and have conversations with them around providing appropriate evidence to allow the digital link criteria to be met. In some circumstances, the systems are not very good. So in the event that you can't make the proper change and the systems can't be amended, that's when you would go to HMRC and you would seek even an extension to start date to comply with Making Tax Digital 2, or even try to agree a proper workaround. Some adjustments like partial exemption adjustments or things like tour operator's margin scheme, for example, are adjustments that can still be done outside the digital link criteria and just added in manually. So again, lots of devil in the detail in respect of what's allowed and what's not allowed. And I think the key thing really is that HMRC, when they introduced MTD, didn't really have much of a clue about how businesses work in practice from a practical perspective with systems talking to each other. So they are willing to listen, and they have been willing to approve workarounds where possible. So hopefully that answers the question.
I've got one for Katie, who I can't see, but I'm hoping Katie is still with us here on what you were saying about the R&D. There you are, brilliant. The R&D tax benefit. Someone asking for clarification. They had always assumed that it was IT, and you mentioned cocktail recipes. So if it's anything that they can apply a science tick to, can that be included? I think that's clarification on something you did say, but just to reiterate.
Yeah, absolutely. So the most common claims we see across the sector are technological, but certainly if you've got work on food science in one area or another, and that's where these weren't kind of let's just mix a few different ingredients together. There was slightly more to it on this cocktail side, but certainly worth pursuing if you've got something you think is from a food science point of view, and that might be extending shelf life dates. It might be how you can manufacture at scale. It might be combining ingredients that just haven't been done before, and how you can do it. So in this case, it was there was some frozen ingredients and some dried ingredients. So there was sort of process involved as well. So while I sort of flippantly, I guess, include new recipes for cocktails, so it has to be a scientific element, but certainly, yeah, not restricted in any way to just technology.
Okay, that's brilliant. Thanks for that clarification. I've got some comments here. I think, Mark, you might have to sort of scoop this one up. Somebody's asking if there's any chance of the ETAC to help out or any similar schemes being reintroduced. And then coupled with that, someone's made the comment on the only comment today on paying for the COVID expenditure has been the increase in corporation tax. Everything else has been, I guess that's what BDO are for, is to help people with how much they're paying to HMRC. But how will COVID be paid for? So 2 questions there.
This sounds dangerously political, doesn't it? Look, you can see everyone's smiling because you suggested that I answer it rather than anyone else. So let's start with the first thing. Is Eat Out to Help Out likely to come back? That sounds like a political nightmare if they said yes. I think they've probably learnt their lesson, and I suspect they won't. Not least because when we look at the trading patterns to date in terms of people actually going out and eating, you know, Eat Out to Help Out was there to persuade people to go back and go out. The early data from the 17th of May is suggesting that in certain venues they are already exceeding their 2019 performance levels, some 35% for pubs. In outside space, clearly the weather's helping. So actually, in terms of the reason for it, I suspect the answer is no. That doesn't necessarily, the next point is, well, what support is there for various industries? I suspect we won't know exactly how things are going to be paid for until we know what happens on all of these other issues. I think, as Sarah highlighted on the lease forfeiture, you can't really go to businesses and say, right, I need you to pay a whole load more, but by the way, you need to pay all of your back rent with no support in the meantime. So I think the government is fully aware that until employment starts being reset and until businesses are on an even footing, they can't really plan for how they recover the monies. But let's face it, it's going to be a challenging few years in terms of trying to make sure we can pay for all of this. So I'm going to give no further answer on that, I'm afraid.
No, I think you're right. Possibly that was a bit cruel of me to bring up something that was maybe erring on the political there. Always a tricky one. Somebody else is asking. You mentioned, not you, Mark. I think it was Martine, on deposits and vouchers. Is there standard wording that people, you mentioned, I think, standard wording on terms and conditions. Is there somewhere that people can find what they need to put on those terms and conditions, or is that so individual they need to speak to you directly or to their financial expert?
Yeah, so there's nothing standard out there, and actually the HMRC's guidance is not overly great. I say it's quite subjective. As I say, we've seen a term with HMRC saying any prepayments, any monies retained for cancellations, for example, will be related back to the supply being made. I think in order for there to be a proper cancellation charge or cancellation position, your individual terms and conditions would need to be reviewed, and still could be subject to challenge by HMRC. We find it quite difficult. We've seen it as well in respect of construction and the whole wider industry piece around, can we still really have a cancellation charge or a compensation payment? Even things in the property world around dilapidations, there's been question mark over some of these supplies that wouldn't be subject to that previously. Now HMRC are really focusing and trying to bring back money into the revenue by taxing things that they weren't going to tax previously. So it links back quite nicely to Mark's question a minute ago. How are HMRC going to make us all pay for the COVID easements that they've given us? And I think being subjective on some of the VAT stuff we've already seen. We've come out of Brexit and HMRC, we've seen HMRC take decisions around some of these things. So yeah, it'd be interesting.
Thank you. This one here on super allowance. Could this apply to any refurbishment type of expense, or are there particular rules like there used to be for enhanced capital allowances? And the example given is Dyson hand dryers qualified, but other brands didn't, curiously. Could we claim this for charging outdoor, our door locking system? So that's sort of mobile key entry to bedrooms. So I don't know if, James, you want to take that, or Jackie?
It won't be Jackie. I don't know. We do have a member of our compliance team, Sean, on the line. I don't know if he wants to take that. If he doesn't, I'm happy to give it a go.
Hello. No, yeah, happy to. So yeah, there is a big difference between what's available for the super deduction and the enhanced capital allowance that used to exist. And the reason why some hand dryers qualified for the old enhanced capital allowances is because that was on performance criteria. So essentially, it was only available for energy saving plant machinery, whereas the super deduction now is much wider. So super deduction is available for, is completely uncapped, and it's available for any expenditure on main pool plant machinery. So that will include things like hand dryers and any brand of hand dryer. It will include anything like furniture, sanitary ware, fire alarms, anything within the main pool of plant machinery. But it's definitely more widely available than the old enhanced capital allowances that were available.
So that specific question on door locking, so that would fall into that.
Yeah,
plant.
door locking, yeah, door access, yeah, that falls into main pool plant machinery. So yeah, that's another good example of what will qualify for the super deduction.
Great, thanks very much, Sean. Thank you. And one here, I'm not sure it quite makes sense. I just need to check what it says. If refurbishment occurred during lockdown with the hotel closed using bank financing, the interest cost can still be taken to the P&L with policy disclosure in notes of financial statements, and that's got a question mark at the end. I'm not. So yes, I guess if there has been bank loans for refurbishment, can the interest cost be taken into the P&L?
That's an excellent question, and one that I'm going to pause and say someone should consult their their auditor or their advisor to think about it carefully. The reason I'm thinking is, so again, under different gaps there are rules about whether you must or whether you can capitalise. The question is suggesting whether you can take to P&L. Under IFRS you must capitalise where you have borrowing costs for development. The reason I'm pausing is because if there's a question mark as to whether you're closed because of the refurbishment or you're closed because the government said you weren't allowed to open, and therefore whether it's strictly a development activity. Now I would suggest if you are actually borrowing specifically for financing a refurbishment, then that would count as a qualifying interest expense, and then it would depend which gap you're under as to how you treat it. But I would be cautious about having a generic response, if that's okay, and say that we should look at the specific details case by case.
Yeah, no, that's fine. Thank you for that, Mark. And I think this is probably our last question with 3 minutes till 10 o'clock. So it's one, again, from Martine, VAT on deposits. Where a corporate guest has paid the deposit and they ask for a VAT receipt, are we obliged to prepare such document for them to recover VAT on deposit? Your earlier answer seemed to indicate no. So we're sort of doing full circle here.
Okay, so this is to a corporate client rather than a private individual in that example. So there's no requirement to issue a VAT invoice to a private individual. So that's a little bit different. Corporate client, so there is a requirement to issue a tax invoice. Now, if you are if somebody's paying you a deposit and you're asking them to pay VAT as part of that deposit, then strictly speaking, that creates a tax point and a supply for VAT purposes. So strictly speaking, you probably should issue a tax invoice for the part supply. A little bit different to the prepayment question previously. And then you'd issue a balancing invoice for the difference at the time they pay for the final part of the supply being made. So that's probably the correct route to go under. The issue is the fact that a deposit creates a tax point for VAT purposes, even if an invoice isn't raised, because it may be received, tax point is created the earlier of supply being made, cash receipt or invoice issued, and there's some different rules around that. So yeah, I would say if somebody's asked you for an invoice to support a deposit that they've paid because you want to charge them the VAT and you want to report that, then yeah, there would probably be a requirement to issue an invoice at that stage for the deposit amount.
Lovely, thank you, Martine. We have another on sustainability, but I'm not going to cover that because actually it takes me nicely to our annual conference at the end of November, where a big part of our agenda for the conference will be sustainability. So I'm sure we'll cover that from a finance and tax relief perspective as well. So we won't do that one today. So really, I'm just going to close our meeting today and thank everybody for listening, for taking part and for sending in your questions. And just to remind everyone that the topics discussed today have been done so in a very general manner, and each business has its own unique set of circumstances. So if anybody needs formal advice, then please approach your professional advisors or come to me for an introduction to any of the experts here from BDO. And a big thank you to the team at BDO. It's always such a useful event for us, and I find it particularly interesting as I get my update from you. So thank you all very much for joining me today. Our next online session will be a demo from our sponsors Use, who will explain how you can simplify your entire AP process. So if you're interested in finding out more about that, please go to the HOSPA website to register, and that's taking place on the 22nd of June, 10 AM. So once again, thanks to everybody for listening, for taking part, to sharing your wise words, and we look forward to seeing you all again soon. Thank you very much and goodbye.